This is Nightly Business Report with Tyler Matheson and Sue Herrera.
General Electric plans to sell off most of its GE Capital units. So what does it mean for the new GE and investors in one of the most widely held stocks anywhere? No stone unturned how Blackstone, the private equity giant, is becoming a real estate behemoth as well. And a little love. Our market monitor says she has some of the best names to own. They're the ones investors love to hate sometimes, and she's got some names for you. All that and more for Friday, April 10th. Good evening, everyone, and welcome. Sue Herrera has the evening off. We'll talk about ending the week with a bang. General Electric is continuing its makeover, and in this case, it's an extreme makeover. Last night, we told you the widely held Dow Component was close to a deal to sell its real estate portfolio. What we didn't know was that that was just the beginning. The company is planning to essentially shed its entire finance unit. The first move is a $26.5 billion sale of most of its real estate and mortgage portfolio to Blackstone and Wells Fargo. But GE is not stopping there. The company will dramatically slim down GE Capital over the next few years and buy back $50 billion worth of stock. That buyback ties Apple for the biggest single buyback ever. Wall Street loved the moves and sent shares higher by about 11% on the day. Mary Thompson has our look at the deal and the new GE.
In his most aggressive move in 14 years as CEO, Jeff Immelt plans to slash the size of GE's finance unit, a business once a strength for GE, now seen as a drag.
And we kind of felt from an investor standpoint that this was the right time.
The right time because low rates mean yield-hungry buyers will pay up for these assets. And selling them means GE may be cleared to come out from under a stricter regulatory regime mandated for firms deemed systemically important. The news sent the stock to a 52-week high, earning praise from investors.
I think GE is doing the exact right thing. Now you can understand the company.
For Immelt, the restructuring puts GE on the path to be a pure industrial play, a company providing tools to build out infrastructure around the globe, and one that won't be penalized for its financial business.
At the end of the day, being able to re-rate the company as a premium industrial company with a very small financial service business that really complements the industrial assets, I think is the highest, is really a value-creating move.
Value Immelt struggled to generate as the stock's off 30% since he took the helm.
I definitely think he heard the critics and he's answering them.
By 2018, 90% of GE's profits will come from its core industrial businesses, including power and water, aviation, healthcare, oil and gas, and transportation. That's up from just over 50% last year. Profits from finance will drop to 10% from 42% in 2014, as GE looks to unload $165 billion in assets, including U.S. and international banks and global commercial and consumer lending businesses, all over the next 2 years. GE will hold on to businesses that finance client purchases of its jet engines, energy, and healthcare equipment. Even as it undertakes this massive restructuring, GE still expects to meet profit forecasts for 2018 and will make up for lost earnings at GE Capital by growing profits at its industrial businesses and with a record $50 billion stock buyback program that will significantly shrink its shares outstanding. All moves designed to keep investors engaged as the 123-year-old company starts yet another new chapter. For Nightly Business Report, I'm Mary Thompson.
So why would a company want to part with a unit, GE Capital, that accounts for 2 out of every $5 it earns in profit? Bill George is here to discuss. He's former CEO of Medtronic and now professor of management practice at Harvard Business School. Bill, great to have you back. Take us inside the mind of the CEO, inside the boardroom. Why do you do this?
Well, I think, Tyler, Jeff is taking GE back to its roots of getting transportation, energy, healthcare, industrial businesses where it can use its research and development, its capital expenditures, and, by the way, its financing clout on industrial roles. But the consumer finance business has gone the wrong way. It's very hard to get good returns today in the new regulatory era we're in this field, particularly if you're not a bank the size of Wells Fargo. And I think that, and getting rid of the real estate, these things really made GE into a conglomerate, and I think the market couldn't figure it out, and I think a lot of customers couldn't figure it out. So I think it's good. The conglomerate model we didn't challenge it under Jack Welch because he was managing so well. But I think today doesn't make any sense. And so I think the integral unit he has makes a lot of sense. And keeping the financing. Jeff once told me, he came to visit me at Medtronic when he was in charge of the whole imaging business. And he said, look, we use the financing to support our sales of MRIs and CAT scanners and all the equipment they sell. And so the same is true in jet engines. The same is true in the energy business. They use these very effectively. But that's very different than consumer finance. And I think GE got way too dependent back when Jack was CEO. The only question I have, Tyler, is why didn't he do it sooner?
Yeah, well, a lot of people ask the same question, particularly in light of what has been an underperforming stock price. So in this case, Bill, it gives them more sort of strategic focus. Smaller is better. They won't have as much profit now. They're hoping, I guess, that they'll have it later on. Do you see, you mentioned the medical imaging business. Some people see that now as not fitting as well as it once did in a company that is focused on industry and infrastructure.
Well, I wouldn't agree with that. I think GE should be doing more, not less, in healthcare. I think the opportunities, Tyler, as a growth industry, healthcare is where it's at. Energy is too, by the way. And I think using their technology and their innovation and the kind of things he did in the energy side, eco-imagination, use the same thing on healthcare, Tyler. That's their sweet spot. This is the real GE that Jeff's taking the company back to, and I think that's exactly where they should be. And they should be pushing this large equipment. That's what GE does. You know, a company like Medtronic does implantables. So this is what they do well. And I see no reason why they wouldn't continue to try to do this around the world and build their global business in a rapidly growing market.
And this is now Jeff Immelt's company totally. He got rid of NBC Universal, which, of course, owns CNBC, which produces this program, and also now a big part of the Welch legacy of the old General Electric, right? Quick thought?
Well, I think Jeff was too slow on that, but I have some empathy too. I think he felt he needed to he knows the lead times to develop innovation, new ideas, and he wanted to go to a slower transition. I wish he'd done it sooner than 13 and a half years. Certainly on the NBC side. I talked to him a few years ago after he got rid of NBC, and that made infinitely good sense. And I think now this makes sense. He could have done it a few years earlier, but he's basically restructuring his balance sheet too. He is downsizing, but he's taking a lot of capital off the table. And he's doing a lot of good things in that regard. So he's giving his shareholders something closer to an industrial, high-tech, pure play. And that's where Jeff wants to go. That's his background. And I think it's the absolute right thing to do because most of GE's executives come out of these fields. And so I think you'll see the company be much more successful in the future. And I think its customers, its employees, and shareholders will rally around the new GE, not being caught up in the ego of being the biggest, but being caught up in being the biggest in each of their fields and being really excellent and having an integrated strategy as they now have. So kudos to Jeff.
Thank you so much for being with us. Always enlightening. Bill George with Harvard Business School and a former CEO. So what does this mean for investors? Dean Drey follows GE for RBC Capital Markets. Dean, welcome. Good to see you. What do you think? They fell in love with this move today. Are they going to stay in love?
Well, Tyler, you don't see big cap stocks of GE size going up almost 11%. This was a catalyst, and I think what you're also is important, what happened today is there were so many PMs that were underweight or naked GE, and it's a big index stock, and suddenly you get a catalyst, and it causes you switch from greed into fear, and you had almost panic buying. We call this a melt up. Stock was almost 10 times its average daily volume.
How do you feel about this stock 3 years down when they have exited some of these businesses that Bill and I were just talking about?
Well, it was actually, Bill was making some great points. If you project and follow through this whole plan and do these buybacks, you then have pared GE down to really its core businesses that I think resonate well with investors. Big industrial, service-based businesses with a healthy dividend and investor-friendly, and you've de-risked the company significantly. I think that's what the market's telling you today.
What rating do you have on the stock? And I note that you had earlier a $28 a share price target. Will you revisit that?
Sure. We have a outperform rating on GE. And interesting, at the beginning of the year, we named GE as our top pick of stocks most likely to make a transformational portfolio change. What surprised us, and I think what surprised the market, is they did it all at once. It wasn't just, the next phase. So we're looking at this now. The price target's under review. We still feel very good about how the company has laid out this plan. If you want to project out 3 years, you start looking at a stock that's growing 10%, pays a 3.2% dividend yield that has been de-risked. That feels, in this low growth environment, awfully nice.
That's really good. And I should have pointed out that you guys had some prescient calls on General Electric back earlier this year in terms of a transforming transaction of the sort announced today. All right, thank you, Dean. Great to be with you. As we said, Blackstone, the private equity firm, was one of the buyers of GE's real estate today. The company also made another deal buying real estate investment trust Excel for $2 billion, and that expands its rapidly growing mark as a global real estate powerhouse. Diana Olick takes a look.
There is no real estate Blackstone doesn't touch. Landmark offices, apartment buildings, single-family rental homes, medical buildings, student housing, hotels, $81 billion worth of investor capital under management. Now, as part of GE's house cleaning, Blackstone adds $14 billion more.
In this market environment, it's very difficult to place a lot of money all at once. And given the amount of money that someone like Blackstone is clearly looking to put to work in the market, it would be very difficult to cobble together a portfolio of that magnitude, 1 or 2 properties at a time.
About $3 billion in office properties in Chicago, Southern California, and Seattle, as well as billions more in commercial properties and mortgages across Europe, Australia, and Mexico.
They must have a relatively bullish outlook on the sector overall. Otherwise, we wouldn't be talking about the kinds of dollar volumes that they're clearly talking about in this case.
Blackstone has been in the news most recently in its hotel maneuverings after its $26 billion leveraged buyout of Hilton Worldwide in 2007. It took the company public again late last year. That was just after its sale of San Diego's landmark Hotel del Coronado early last summer, which Blackstone's real estate chief John Gray described to CNBC's David Faber.
The nature of our business, we have to sell. We have closed-end funds. We say our models: buy it, fix it, sell it.
Blackstone is now the nation's largest landlord in the single-family rental market, with more than 45,000 properties under its Invitation Homes. It continues to buy distressed properties, albeit at a slower pace.
At the peak, we were as much as $150 million a week.
Blackstone is taking advantage of a real estate market that's still in the early stages of recovery. With the exception of red-hot apartments, most sectors still have a long runway ahead, with plenty of potential for profit. For Nightly Business Report, I'm Diana Olick in Washington.
Back above 18,000, that's where the Dow Jones Industrial Average ended today, and it largely has GE to thank for it. The Dow Jones Industrial's up 98 points to close at 18,057. NASDAQ rose 21 points to within a hair or so of 5,000 again. And the S&P 500 notched a gain of 10 points, and that puts it back above 2,100. For the week, all 3 indexes were up more than 1.5%. Well, it could well be the highest level meeting between the two countries in more than 50 years. President Obama coming face to face with Cuba's leader Raul Castro at a summit in Panama. Michelle Caruso Cabrera has more on this historic moment.
The president arrived in Panama last night, and we learned today that he spoke with Raul Castro over the phone on Wednesday, and that he and Castro are expected to see each other at the opening dinner, which begins tonight at 9 p.m. Tomorrow is the big event, though, when the two are expected to actually hold a discussion, though not an official meeting.
We certainly do anticipate that they will have the opportunity to see each other at the summit tomorrow to have a discussion. So we will keep you updated as to any interaction between the leaders.
This wouldn't be the first time the two have met. They shook hands very briefly in December of 2013 when both were in South Africa for Nelson Mandela's funeral. President Obama's chief of staff said at the time that that meeting was not planned. This meeting will be the first time they are together since they announced the decision to reestablish diplomatic relations in December. One of the key issues, Cuba's inclusion on the U.S. list of state sponsors of terrorism.
removing Cuba one of the changes that would pave the way for the reopening of embassies, which have been shut for 54 years. It will also make it much easier for banks around the world to do certain kinds of financial transactions with the sanctioned island. And just last night, the State Department officially recommended removing Cuba from the list. It's been on that list since 1982, when it provided sanctuary to terrorists, including Colombian FARC rebels and members of ETA, which is a Basque separatist movement in Spain. Other countries still on the list: Iran, Sudan, and Syria. By the way, Raul Castro is the first Cuban leader to attend the Summit of the Americas because the U.S. has historically opposed a Castro attending the event. So we are already seeing changes in hemispheric relations. For Nightly Business Report, Michelle Caruso Cabrera.
Well, one person who has long been a supporter of improving relations with Cuba, Hillary Clinton, and the former Secretary of State and First Lady, is expected to announce on Sunday that she will enter the race for president in 2016. It is believed Clinton will make her announcement via social media. And coming up, our market monitor loves cost-cutting companies. She's got a couple of names she thinks can get you at least 20% over the next few years. Apple Watch hit stores for the first time today. Not that you could buy one at a store, pre-orders only, and those orders had to be made online. But in the store, you could get a chance to see one, try one on, put it through its paces, and by all accounts, the watch appears to be a success. Within hours, most of, if not all, models seem to be totally spoken for. If you want one, now figure on June at the earliest. In China, the top-of-the-line model, which costs in the neighborhood of $20,000, took less than an hour to sell out. Around the world, people lined up to test out the new gadget.
We've come to see the watch.
I ordered the watch last night at like 3:15 a.m.
We haven't bought one, but we're probably going to come back and get one.
My kids are asking for iWatches, and I'm like, no.
If it's like an iPhone, is it going to be updated every year?
Some people are skeptical now, but I think in time to come, everyone will have one.
Shares of Symantec rallying into today's close on a late report, and that is where we begin tonight's market focus. The company is reportedly exploring a sale of its Veritas data storage and recovery business. The cybersecurity company's unit could fetch more than $8 billion. Shares were 5.5% higher. They finished at $25.58. New details tonight on eBay's split from its PayPal unit. The two companies will still be interdependent on one another even after they split. eBay agreed not to create its own payment system for 5 years after the split, and PayPal won't create an online marketplace. So there, shares were up a fraction to $57.34. Amazon, one step closer, apparently, to its dream of delivering items with drones. The company won federal approval to fly drones to research and develop the technology, but there are lots of restrictions. They can't fly higher than 400 feet, faster than 100 miles per hour. That's pretty fast. And they have to stay within the operator's line of sight. They are also only allowed to fly during the day and on private property. So the company still has a long way to go before they can fly you your next shipment of cat food. Shares were off a fraction to $382.65. Nokia is reportedly exploring the sale of its Maps business. The unit is attracting interest from Uber, the car booking application, and from private equity firms. The business valued at about $2 billion. Shares popped today 4% to $8.06. Shares of Tecmira also higher on FDA approval of a drug. The drug maker now has the okay to continue its clinical trials of an Ebola treatment drug. Last July, regulators put the drug on hold until more information could be provided on safety and efficacy. The stock popped more than 3%. $18.19 was the close there. And our market monitor tonight has some unloved stocks she thinks investors should own in their portfolio. She's Diane Jaffe, Senior Portfolio Manager at TCW, an asset management firm with $180 billion under management. Diane, welcome. Good to have you with us.
Thank you, Tyler. Good to be here.
Let's start by just sort of a rundown of your overall view of the market at today's levels of 2 weeks in a row of gains. We hadn't seen that in quite a while. And back above 18,000, close to 5,000, 2,100 on the S&P.
I was glad that the market paused during the first quarter to let the commodity prices sink in and let companies figure out how they were going to react. And now I think that we're going to be very interested to see what first quarter earnings bring, and I think the market is stronger from here.
What do you think first quarter earnings are going to bring? And will the rising dollar be the excuse du jour?
I think that the dollar will definitely have an impact, but when we talk to our companies with overseas sales, they would much rather have a stronger Europe, a stronger Japan to sell their products to.
All right, let's move on to some of your picks. You liked GE before, let the record show. You own it before today's news. Do you love it even more now?
I do. You know, I would heartily, it's one of our largest positions. We still believe there's at least 20% upside. It's selling at 2.2 times price to book. And it's now reaching the point where, in terms of dollar price, that it hasn't seen since the crisis.
You must feel very good today because it's been a long wait for GE.
I feel good for our clients.
All right, all right, good enough. Let's move on to your next one, which is another long-time unloved stock, and that's Citi.
Yes, and that isn't having much love this year, but we think it too is continuing its restructuring plans in terms of asset sales in Central America and Eastern Europe, and it's trading below book value. And so while, you know, it passed the CCAR, the stress test earlier this year, we think it's got a lot of room to run over the next 1 to 2 years.
And your third one is Chesapeake Energy, a stock which either has a history or a past.
We're gingerly pacing our investments in Chesapeake right now. It's trading below price to book. Generally, E&P companies trade best on price to cash flow. It's trading at 2.5 times price to cash flow. And what I feel good about is that it has over $8 billion of money in the bank, so it can wait out a long-term low commodity environment.
Is your investment in Chesapeake an expression of bullishness about the sector broadly or about the particulars of this company?
We have been underweight energy for most of 14 and continue to be underweight energy in 15, but we want to take opportunities that the market's presenting, like Chesapeake.
All right, Diane, thank you very much. Great picks, and thanks for moving quickly through them. We appreciate it.
Thank you, Tyler.
Diane Jaffe with TCW. All right, Citi upgrading Netflix to buy from neutral. That lifted shares of the video streaming service. The note saying it doesn't agree with the competition concerns that are already reflected in the stock's price. Shares rose about 3.5% to $454.57 on Netflix. Citi adding General Motors to its Citi Focus list, sending shares higher today. The firm says it sees the recent pullback in the stock as a buying opportunity and says the company has very strong fundamentals. Shares up slightly today to $36.57. Coming up, breaking up can be hard to do, but some visionaries are trying to ease the pain of divorce while trying to build a business. Here is what to watch next week. Busy week, earnings season in full swing. The biggest part of it, the big banks start reporting early in the week. JP Morgan, Wells Fargo, and many, many more. The Federal Reserve's Beige Book, love that Beige Book, out Wednesday and could offer some insight on the health of the economy. On the data front, a ton of potentially market-moving reports, including retail sales, housing starts, jobless claims, and those, folks, are some of the highlights of next week's agenda. And finally tonight, divorce can be a messy business, but as Jane Wells tells us, some people are turning that messy business into good business.
The luxurious Gideon Putnam Resort in New York's Saratoga Springs is a favorite spot for weddings. It's also the spot where Catherine and Jonathan, who don't want their last names used, got divorced.
Well, it definitely suited our needs. We have children, and early on in this process, we made a decision to be the best parents possible.
The resort is the first U.S. venue for the Divorce Hotel, already a successful company in the Netherlands. Its purpose, low-priced, quickie divorces for $10 grand. Check in married on Friday, check out divorced on Sunday.
We launched in September of 2014, and since then we've done 12 divorces. We just finished our 12th yesterday.
This isn't the only unusual business in the divorce industry. Another company will finance your divorce battle in exchange for a piece of your settlement, assuming you get one. Balance Point Divorce Funding was created by Stacey Knapp, who funded it with her own divorce settlement.
We haven't lost money on a case yet, so it will happen. I am sure it will.
With Balance Point, a lawyer estimates how much a divorce will cost. Knapp funds it in portions, and the more she invests, the higher her percentage on the back end. But she never goes above 25%. She won't, however, fund everyone.
I've actually had somebody say to me, I won't settle ever. And I said, really nice meeting you. I can't do anything for you. Because at the end of the day, it has to be about a business, because I have investors to answer for.
Those running the divorce hotel agree this is only for people who want to end things quickly and relatively painlessly.
It was nice to get away for a weekend in a beautiful setting where you could relax, get away from family, friends, and really focus on what needed to be done.
And though it can be romantic spending the weekend here, no one has had second thoughts.
Every couple has left saying they've gotten along better than they ever have, but they're not getting back together. They've made that decision.
For Nightly Business Report, I'm Jane Wells.
The Heartbreak Hotel, maybe, the Divorce Hotel. All right, that's it for Nightly Business Report for tonight. I'm Tyler Matheson. Thanks so much for watching. We hope you all have a really good weekend, and we'll see you back here on Monday.